What are Section 1231 gains and how are they taxed? Imagine selling a piece of your business or property and wondering how the government will tax your profit. That's where understanding Section 1231 gains can make a big difference. Section 1231 gains come from selling certain business assets that you have held for more than 1 year. These assets include real estate, machinery, equipment, and buildings used in your trade or business. But remember, inventory or property mainly held for sale to customers does not qualify. When you sell these assets, the profit or loss is not taxed immediately as ordinary income or loss. Instead, all your gains and losses from Section 1231 assets for the year are combined. If your total gains are more than your losses, the net gain is usually taxed as a long-term capital gain. Long-term capital gains are taxed at lower rates, which can save you money, especially if you are in a higher tax bracket. If your losses are greater than your gains, the net loss is treated as an ordinary loss. This means you can deduct it against other income like wages or business profits. Ordinary losses are not limited by the $3,000 cap that applies to regular capital losses, so they can be more helpful in some years. There is also a rule called the non-recaptured Section 1231 loss. If you had net losses from these assets in the past 5 years and now have a gain, part of that gain might be taxed as ordinary income. This rule stops taxpayers from timing gains and losses to get the best tax outcome. Another important factor is depreciation recapture. When you sell depreciable property, part of your gain might be taxed as ordinary income because you claimed depreciation deductions earlier. Only the remaining gain after recapturing depreciation qualifies as a Section 1231 gain. Knowing how these rules work can help you plan your sales better. For example, timing the sale of assets can help you maximize your net gains or losses for tax benefits. Keeping good records of your asset sales and consulting with a tax professional can make a big difference. For those focused on retirement and investment taxes, understanding Section 1231 gains can help you make smarter decisions about when to sell assets. Proper planning can reduce your tax bill now and improve your overall investment strategy. In short, if you sell business assets held longer than 1 year, your profit might be taxed as a lower rate long-term capital gain. If you have losses, they can offset other income as ordinary losses. Special rules about prior losses and depreciation recapture add some complexity, but with good planning, you can make the most of these tax advantages. For Asian American business owners and investors, understanding these rules can help you keep more of what you earn and plan for a stronger financial future.